Good morning.
Good morning. Hi.
How are you?
Thanks so much for doing this again.
No, my pleasure. I'm very pleased to be on.
So we've got a presentation, so I'll let you kind of run through that, and then we'll start asking questions if that's okay.
That sounds terrific. Yeah.
Good. There we go then.
Well, first of all, I mean, thank you for inviting me on here today. I mean, obviously we're at a really interesting time in markets, and interesting not in necessarily a terribly good way. And you know that we often start Troy presentations. I know you had Sebastian Lyon, our CIO, on not very long ago. And he reminded people that the roots of Troy come from Lord Weinstock, who, as you know, is an industrialist, had a Derby winner called Troy, but also that the business was founded in 2000, which I think is quite relevant to today, not because I think we're in a dot-com boom, but because I think we are in a situation that's not that dissimilar. And I'll tell you why, because in 2000, the thing that really drove the final blow off top in markets, I think, was because of the so-called Y2K problem, which you may remember. They were terrified that the computers were going to just basically stop working as we went through to the new millennium. And so they flooded the system with liquidity, and it drove markets to an all-time high. I think COVID may have played the same role here. At the low in March 2020, it was very scary. We didn't know how bad things were going to get. And they also then really went for it in terms of policy, both in terms of monetary and fiscal policy, which has driven this incredible market move in the last 18 months, which shows signs of beginning or is rolling over. So I wonder if COVID, rather than marking a cycle low, created the conditions to drive policy to drive a cycle high. And I think that's what ultimately is happening. And so, although Ukraine is absolutely horrific, and we're all horrified by what's going on, the slowdown is probably would have happened anyway. And that's relevant to how we manage money at Troy, because we seek to preserve capital. People who have money, generally speaking, don't want to lose it. And we think, therefore, you should think in terms of absolute returns, in terms of real returns, and concentrate on resilient, high-quality businesses. Leave behind those that are more cyclical, that are weaker, that are not going to be around for years and years to come to deliver both capital and income. And that's how we try and invest at Troy. We try and keep portfolios fairly concentrated. We keep turnover down to avoid mistakes and to allow our capital to compound, and we have high conviction. Now, of course, Troy is best known in the investment trust sector for the Personal Assets Trust, which is managed by Sebastian Lyon. And I always think people have a very clear picture in their mind of what that trust is trying to do. It's a low volatility, conservatively managed, quality focused trust with an emphasis on downside risk. Well, we hope in time and think in time that the Securities Trust of Scotland will be thought of in similar terms in the global income sector. So we want people to think of it as a quality focused, low volatility global income trust. And given the backdrop and given the uncertainty we're facing, we think that that's a very attractive and important vehicle for investors to be able to access. And obviously we're delighted to be able to offer an investment trust. Why we are delighted to offer an investment trust? Well, because I don't need to tell you, James, but investment trusts have certain attributes which are an additive or a plus, if you like, for private investors, for individual investors. You know, we have a strong board. On our board, we have 3 seasoned investors. We've got an ex-FTSE 100 CFO. We've got a fintech and digital marketing expert. You know, they're a really interesting group of people, and they definitely are additive when we have to report about what we're doing in the portfolio. We also have a revenue reserve, you know, so we can smooth the income. Now, of course, that's pretty important, and if we are moving into a more difficult time, could be very valuable. When we took on this trust, we took the income level down to what we believed was a sustainable level and covered by cash flow. And we've also rebuilt the revenue reserve. So we're well placed, we think, to continue to deliver smooth income. We can have an element of gearing. Securities Trust of Scotland is currently about net 6% geared. That could increase marginally should equities become significantly better value, and particularly if borrowing costs remain low, and we can talk about that. And finally, we have a discount control mechanism. You mentioned there are lots of different ways of managing discount, and we'll talk about that a bit later in the presentation. But we try and keep our processes intuitive and simple as possible. So we invest in a concentrated portfolio of high quality businesses. We want to generate above average returns, but with below average volatility. That matters because if you have irreplaceable capital and you're in need of income, then we think that volatility matters, because you probably are retired and you may not have a long period of time to recoup steep losses. Furthermore, if you are requiring of income, it's very difficult to come by these days. And so we think people are probably taking a bit more risk with their capital than they would have done traditionally. And therefore, we are very cognizant that we want to be delivering a return that doesn't scare people too much, and having low volatility is part of that. We're also minded to remind people that income does have a role to play. And if we are moving into a more difficult world, that is the case. I always remember a time at the low in 2008 when a great friend of mine rang and said that his mother was deeply concerned because the market had fallen so far that she was worried that if it continued to fall, she was going to struggle. And the obvious question I asked at that point was, well, how much income does the portfolio generate? Because if she can cover her day-to-day expenses from the income that the portfolio is generating, then she doesn't have to worry. She can continue to let the portfolio be settled and not sell capital. And that indeed is exactly what happened. So income's been very out of favor because markets have been appreciating so quickly. But I think that the importance and resilience and dependability of income will come back into favor should we be in a more difficult time. So how do we think about investing at Troy? What companies do we invest in? Well, we're showing here that we try to avoid capital intensity and cyclicality. And therefore we have we think you should be highly selective about the businesses in which you invest. And that harks right back to the beginnings of Troy. So get away from benchmarks and get away from low quality businesses. So we have a core of those on the left of this chart. So consumer goods, healthcare, and particularly enterprise software. We feel that enterprise software is probably rather more resilient than consumer technology companies, which got a bit of a bump, we think, from COVID, but seems to be in the process of unraveling, or at least diminishing. And we have a number of investments from the center of this chart. What we don't have is the businesses on the right-hand side. And we would say that they're broadly in two camps. One is that sectors that are now structurally challenged as a result of technological disruption. And I would put telcos, utilities, retail, and so on in that camp. And there are others that we view as too cyclical and too capitally intensive. And it's very relevant to today. So we would include energy, miners, and defense in that. So although we recognize that the backdrop for energy, particularly, and defense companies has improved recently, we still don't think they're inherently very good businesses long term. They have low returns on capital, they tend to be pretty cyclical, they tend to be pretty capitally intensive, and they tend to have, in case of defense, few buyers of their products. So we're very selective about how we go about managing businesses. And I always think the way you should think about this is it's not stock picking, it's business selection. And that's really important. The more careful you are about the businesses you buy in the first place, the more likely it is that you hold them for the very long term. At Troy, we have about 10% turnover per annum in our portfolio, so we have holding periods of 10 years. If you have holding periods of 10 years, it's very important that you are buying a high quality business in the first place. Next slide, please. This we shows that although we have very low, we have pretty concentrated portfolios, 34 companies in this trust, 10% turnover, so 3 or 4 new ideas a year. We are active in terms of the work we're doing behind the scenes and ensuring that we've got lots of ideas. Some of the new investments we've made recently are on the right-hand side. CME Group, Chicago Mercantile Exchange, we bought pretty much in the teeth of the COVID crisis, and is brilliantly positioned because of the untethering of interest rate expectations, if you like, and they are dominant. They're a monopoly provider of a number of futures and options contracts that allow people to hedge inflation and interest rate risk. Fastenal is a US industrial, delivers nuts and bolts and other products to factories. It's a wonderful business, very resilient, growing pretty quickly and highly cash generative. And Nintendo is a business that that many will be familiar with. We're excited about this. We think the market's mispricing it because it's worried about the Switch console being in terminal decline, if you like, or coming to an end of its use. We view Nintendo as much more as a platform business now that they can upgrade the software of that platform via Wi-Fi and sell software via Wi-Fi as well, which is good for margins. And yet the business is priced pretty aggressively and pretty cheaply. We also think they're monetizing their IP in a way that they haven't done in the past, by films, by amusement parks, and so on. There's things changing at Nintendo. We think that's underappreciated by the market. But there are a number of businesses that we would like to own, but that we have felt hitherto to be too expensive. And we're showing 3 of them at the top here. And it's noticeable to me, I was just looking at the numbers before I came here, Starbucks is down 30% from the top, 31% actually. Christian Hansen's down 38% from its high. BlackRock's down 32%. We are seeing some pretty significant moves in markets today. I don't need to tell people that. But that for us is really exciting. Because of our view that we were probably moving into a slowdown anyway, we've been fairly cautiously positioned, but we are moving to a world now whereby some really great world-class global income growth businesses are beginning to fall into our lap, if you like, are beginning to come our way. And so we're sharpening our pencil, if you like, about beginning to take advantage of the sell-off. And on the left-hand side, we've seen Canadian National is a very interesting business, particularly in a more inflationary time. And Admiral Group is a high-quality insurer that I'm sure many are familiar with. Next slide, please. So what does the portfolio currently look like? It's made up of 4 key groups, if you like. This is how we think about it. I mentioned that we have a significant exposure to consumer goods companies, and we're showing a number of them here. The reality is these have been amazingly resilient businesses over decades. They've dealt with wars, revolutions, inflation, deflation, and they've generated excellent returns and excellent income growth over very long periods of time. Now they tend to come into and out of favor. P&G particularly in favor at the moment, having not been so favored not very long ago. Diageo obviously had quite a difficult COVID crisis, but has come out of it very strongly. Unilever is the one that's currently under a cloud, and we can talk a bit more about that. But overall, we think that the strength of the brands that they have, the intangible assets that they have, the depth of distribution, the scale of distribution, and their pricing, their ability to price, makes for really excellent businesses. We might talk about inflation later on, but it's notable to us that these businesses are being able to pass through pricing. And although they are being squeezed currently by the very rapid increase in inflation, we suspect that if inflation does ameliorate at some point, prices will be sticky, but input costs will cease going up at quite the same rate. And so today's margin squeeze is tomorrow's margin expansion. They'll be very well positioned. We've grouped the businesses on the top right here as platform businesses. Chicago Mercantile Exchange and Nintendo I've spoken about. Both are basically software platforms. And Intercontinental Hotel Groups also. This may surprise people in the sense that it's a hotel company, but actually, as I'm sure many are aware, it doesn't own its underlying hotels. It's really a software and branding business. We had IHG in our offices last week, one of the first meetings we've had in person, and there's been quite a lot going on behind the scenes. They managed their way through the COVID crisis brilliantly. They didn't raise capital, equity or debt, remained cash flow positive, which is astonishing given what happened. It's basically shut down, but shows how respectful they are of shareholders' capital. And they've built out their range of brands, which means they can continue to attract hotel operators onto their platform. And they've reestablished their dividend. So things are going well there, and we've recently added to it. I mentioned we have enterprise software businesses on the bottom left. Microsoft and Accenture are both very high quality businesses. We think that the migration to the cloud as companies, as the world economy really pushes on-premise computing power into hosted computing, the cloud, is really only quite early on in its migration. And so both of those businesses are brilliantly positioned. Microsoft is one of the hyperscale cloud providers, and Accenture is a business that helps people make that migration. Paychex and ADP are both outsourced HR software businesses. The imperative to outsource to these companies continues to increase as HR becomes more complicated. And these are just excellent businesses with long runways for growth. We've held Paychex for years, and we bought ADP in the teeth of the COVID crisis. And Relex is a UK business that many will know. Bottom right, we've sort of grouped a number of businesses in what we call historically dependable income. This actually slightly underclubs it, if you like, because McDonald's, Roche, and Medtronic are all world-class businesses, and Link is the biggest, and we think best managed REIT in Asia. But they're all excellent businesses. Medtronic's been a bit slow to recover from the COVID crisis, but we think it will in time. But they're high-quality global income growth businesses. So you'll notice that these are grouped into sort of areas where we want to be committing capital rather than being expressed as relevant to a benchmark. And that's much more descriptive of how we think about it when we're managing the portfolio. Next slide, please. This is the portfolio on an underlying revenue basis. This is how we think about it. We think it's much more important to consider where a business is making money rather than necessarily where it's listed. And you can see that it's a global portfolio. We have very limited exposure to the UK. We have pretty material exposure to the US and the rest in Europe and Asia. The weighting in the US is we think quite logical. We find the US to be the best economy. We find it to have the best businesses, and we consciously want to be allocating capital to that area. I should have mentioned perhaps that in a world where we're trying to produce quality growth and income, we think investors should be very cognizant of the fact that a number of traditionally income-bearing assets are now rather more challenged than they used to be. And so we think you need to be very cognizant of that and to be investing in businesses that can be resilient and can generate income and are not being disrupted. And we do that very consciously at Troy. This, in many respects, I think is the most important slide in the pack. You can see that at a time when markets have been pretty elevated in terms of valuation, we are generating a slightly more than a 5% free cash flow yield, which is covering a dividend yield of about 2.7%. And we think that represents really quite excellent value. That's a free cash flow yield that we think can grow pretty resiliently, mid-single digits. And you can see that it's underpinned on the right-hand side by a portfolio that's much higher quality than the broader benchmark, and so or broader market. And so on an underlying basis, the portfolio is compounding capital at a much higher rate than the broader market. And so if we take a 5% free cash flow yield, which we think can grow pretty resiliently at sort of mid-single digits, that gives you a forward expected return, if you like, of about 9 to 11%. And if you look at my very long-term track record in this sector, which is now 15 or so years, that's roughly what we've delivered on an annualized basis, split equally, not equally, but split between income and capital. So over that 15 years, we've delivered roughly 3% income and roughly 6% compounded capital. Now, our view is for a certain type of investor, and I would put myself in that camp, but if at some stage I would stop working, if I can invest in a trust that delivers me 3%-ish, slightly less today, to cover my day-to-day expenses, and I can compound my capital, double my capital every 10 to 12 years via the rule of 72, well, that's a pretty ideal vehicle in which to invest. And if I can do it in a way that doesn't scare people too much because it has low volatility, well, that seems like an excellent prospect to me. Next slide, please. This shows the portfolio. You can see that we're quite comfortable having relatively concentrated positions in the high quality businesses that we have. We also observe that if you run your winners, if you like, if you hold positions for long periods of time, the portfolio concentrates itself in the highest performing businesses. And we have seen that happen here in this portfolio. But you can see the sorts of size of holdings that we have, and also that we are concentrated in particular sectors that we favor. Next slide, please.
Gone quiet, James.
I was just wondering if you could have the next slide, please.
Oh, sorry.
We talked about the discount control mechanism. Now I know that you, James, will certainly be familiar with this, and many who are listening. But this is where you buy back stock at a discount and issue stock at a premium in a trust in order to control the discount, so that the share price and the NAV trade very close to each other. This was actually pioneered by the Personal Assets Trust. And we view it as an important part of managing investment trusts at Troy, which are core to our business. They're very important to our business, and that we've had great success with over the years. What this enables people to do really is have great confidence that they can buy, but also most importantly, perhaps sell close to NAV. And that counterintuitively, if people know that they'll be able to sell at a decent price, they're much more willing to buy. And it also reduces the volatility. Clearly, when times are tough, if the discount blows out, you suffer a double whammy of both falling share price, but also widening discount. And we want to protect investors from that. The other point about having a discount control mechanism is it materially increases the liquidity of the trust. And so this has a much higher level of liquidity than would be the case for a similarly sized trust. It's about £220 billion, the Securities Trust of Scotland. And it also enables you to grow the trust, which we certainly hope and intend to do over the time, as we have with the other investment trusts at Troy. Next slide, please. This shows the long-term track record, not very much of which has got a great deal to do with us. although I have to say that performance has improved materially. It's very interesting to me. Something changed in markets in February of last year. That was pretty much the height of the most speculative part of this cycle, this boom, if you like. That was the time of meme stocks, of SPACs, of profitless companies having massive valuations ascribed to them, and so on. And we intentionally want to be viewed, if you like, as a sort of almost anti-bubble trust. You know, we want to be getting away from all of that highly speculative areas of the market, which has cost people dearly. And that pretty much coincided with our performance beginning to improve, and it's improved markedly. And we've, on an NAV basis, done a reasonable job of protecting shareholders' capital so far in the downdraft. So yes, we've been managing this from November 2020, and the track record you can see here. Next slide, please. So that, I hope, is a bit of a whistle-stop tour of the trust, but I hope it's given people a clear idea of how we're thinking about managing this trust and how we go about managing money at Troy. We want to be cognizant of the fact that we have seen a world of pretty full valuations and that is subject to a great deal of technological disruption. And for an income investor, that makes for quite a challenging backdrop. Now, we are clearly laying out our stall, if you like, at Troy, of seeking to produce a trust in which people can have great confidence because of the quality of the underlying businesses in which we're investing, and consciously not investing in those companies that are subject to disruption. And this has changed even since I started managing income money 15 years ago. There's a number of sectors which you traditionally would have considered for income, which we now think you shouldn't. And therefore, we're highly selective about the companies and sectors in which we invest so that we can have the optimum balance of quality, income, and growth. We've got quite a strong view on inflation in the sense that we just don't know. I don't think anybody knows if inflation is going to be persistent or not. But what I would say is I think we're reasonably well placed either way. Our view is that interest rates can't really go up very much because there's just too much debt. So if inflation dissipates, and my personal view is that's highly likely. If you look at the flattening of the yield curve, i.e. short-term interest rates have gone up quite a lot, medium-term interest rates have not, and are close to inverting, such that that's usually a pretty clear signal that the economy is slowing, if not going into recession, and that's before we had the Russian crisis. So my view is that inflation may well dissipate, in which case we're really well positioned in this trust, as I mentioned, because pricing will be sticky because of the quality of the businesses in which we're invested, but input costs will moderate, and therefore margins would expand. If inflation is more persistent, however, but rates stay low, then you have an environment of very negative real interest rates. And that's an environment where an index-linked bond will do very well, but also, dare I say it, a portfolio of high-quality businesses that have pricing power. And so if you look at our portfolio in those terms, relative to a linker, it looks really good value. And I think we're well positioned on that basis. So everything that we know about the backdrop, elevated valuations, technological disruption, now the geopolitical risk, makes what we think the Troy approach of being quality focused, of having very low turnover and getting away from benchmarks should, over time, produce a return that we think is attractive for investors. And once again, we're very much hoping, rather like personal assets trust, that we can be seen as the quality, low volatility global income trust in the sector. So that's all I was going to say. I'm very happy to take some questions now if you have any.
Great. Okay, thank you. Actually, I'll start with a recent one. So just can you tell us a little bit just about how the team and how it's organized, please? So what sort of resources have you got in terms of looking at stocks?
Yeah, absolutely. So we've got an investment team of 13. We run 4 key strategies. So we have the multi-asset strategy, we have a UK income strategy, global equity strategy, and global income strategy. We all have a common resource, if you like. We all invest from a universe of companies. We have a universe of about 120 companies globally that we have done the work on, that we like, that we know, and that we can all use to invest in our portfolios. So that universe is managed, if you like, by the team, by the whole investment team. We're not in silos. Now, each of the 4 strategies has subtle differences, of course, but they all have a common thread throughout them, and that is quality as expressed by our universe. Now, the universe isn't static. Companies go into it and come out of it. It doesn't happen very often, but there are new ideas introduced and companies that are dropped. As I mentioned, we've got a portfolio of about 33, 34 companies, 10% turnover. So that's 2 or 3 new ideas a year. And one of them or 2 of them is probably already in the universe. So the whole team in aggregate has to come up with a few individual ideas a year. And that's a function of our process, because we have such low turnover, because we have such high quality portfolios, and because we know what we're looking for in terms of the sorts of businesses that we invest in. It's a very manageable task. In terms of this trust as a whole, it's managed by myself and Tomasz Boniek. We also manage the open-ended structure, and we've recently launched the a ethical variant of the global income open-ended structure, which will be managed by the 2 of us. So you put all that together, we've got plenty of resource, we've got plenty of time, and we've got plenty of ideas. And so that's how we structure ourselves.
Great, thank you. That's an interesting question. So how would the portfolio change if you didn't have the income mandate?
Yeah, so and as I mentioned, we think income absolutely has a place, because for all the reasons I said, and we are very definitely managing the portfolio in order to generate some income, balance between quality and growth, of course. I suppose in recent years, if we weren't tasked with generating an income, then we probably would have had a bit more in the very large technology companies. For whatever reason, they haven't been minded to pay income. Although my history would suggest that as they mature, then they might well. We were able to buy Microsoft in 2013 on a 3.5% dividend yield, on a 13% free cash flow yield. Apple, of course, famously started paying a dividend and then performed very well thereafter. And these companies, these big technology companies, are very cash generative, very capital light, and could pay a great deal of, quite a significant dividend. I wonder if the Meta or Facebook, as it was, share price would have done rather better had they been paying a dividend. Maybe they'll change their mind. And culturally, Silicon Valley doesn't historically pay much of a dividend, but that, again, that might change, and a more difficult backdrop might change that too. Otherwise, not much would have changed. We are very consciously at Troy trying to produce a quality portfolio that also produces income. And I know I keep slightly repeating myself on this, but if you go too far, there's balance in everything in investment, but if you go too far down the income side of things and not enough on the total return quality side of things, you can compromise on the quality of the businesses in which you invest. And that's also expressed by the fact that all of the businesses in the portfolio are from the Troy universe. So there would have been a change of emphasis, and if you looked at our global equity funds, you have there are changes, there are differences between that fund and this fund, but there is also quite a high degree of commonality. There's one last point I'd make as well. There are probably 3 areas in the portfolio that we would consider to be underrepresented currently. And they reside in, first of all, the consumer businesses. So I would say Starbucks is a very good example of that. You've lost 30% of your money from the high in that. And we didn't invest in it because we felt it to be too highly valued, but we could do at some point in the future. And it's not just Starbucks, there are others. It's a good example of it. The second is industrials. We have a number of really high quality, capital light industrial businesses that we'd love to own. But again, they were trading very expensively, and we're patiently waiting to add to those. And the third area is financials. BlackRock, as we showed you on the presentation, is a good example of that. BlackRock's a high quality market proxy, really. But it is in part, its fortunes are derived from the level and activity in markets. And we think if you're trying to produce the perfect portfolio when markets are very expensive, without regard to valuation, then you're probably seeking perfection within an imperfect framework. The imperfect framework is the overvalued market. And that's why we're trying to be patient and disciplined about allocating to that area. And so, yeah, consumer discretionary areas, industrial areas, and financial areas. And the ideal, obviously, is that you have the perfect portfolio at the market low. Now, you'll never achieve that, but that would be ideal. So we're always seeking to try and balance quality, income, and growth. I hope that answers the question.
Great, thank you. There's a few questions sort of looking at the fund and against other funds. So is there much of an overlap between this and Ticket, or this and personal assets?
There is. So once again, they're all derived from the same investment universe, but they're all trying to do a slightly different thing. Obviously, Ticket has a UK focus. Personal Assets Trust has an absolute return focus, if you like, and therefore is balancing the equity portfolio with linkers, gold, and cash. And we have a global scope. Now, I would obviously say you should have a global scope because it gives you the greatest opportunity set. but there are similarities across the funds, as you would expect.
There's another couple of questions about the tobacco exposure. So firstly, from an ESG point of view, is that something that you're conscious of and have decided to ignore, or is it something you just doesn't really factor into the decision making? And also, has the board, specific question, has the board challenged the tobacco exposure?
So I'll take the first and then the second. We just think that if you're trying to balance quality, income and growth, that the tobacco sector represents an outstanding global income opportunity today. Now, we would draw a distinction between ethical considerations and ESG. We have ethical funds at Troy. I mentioned we've launched an ethical global income fund. If people wish to exclude certain sectors, we're very happy for them to do so, and we can provide vehicles for them to do so. However, if it's not specifically excluded, we view them as available for investment. And in this case, what you have is there are lots of cheap assets around today, but there are very few cheap, high quality assets around, and tobacco is one of them. And obviously, the uneconomic selling that's been taking place as a result of restrictions that others have on their funds has created this opportunity. I would also say that these businesses, I wouldn't want to push the argument too strongly, but it is actually the case that these businesses are doing more than anybody else to move people who can, the billion people with a B, billion people, this is not a small thing, a billion people around the world who wish to consume nicotine. They're pushing them into less harmful products. And that's very interesting for a number of reasons. First of all, it's good for society. Secondly, it means that these businesses are much more sustainable than they used to be. It means that and much more, long-term sustainable businesses. And they are providing a way for nicotine consumers to do that. So my view is that they won't be called tobacco companies for much longer. They'll be called nicotine consumer products companies, as people consume nicotine in vaping and in heat not burn and in modern and traditional oral and so on. And so one of the reasons why we have such a material weighting is because they've done very well. And I mentioned that if you run your winners, then the portfolio tends to concentrate itself, and that's what's happened here. So we do take into account our ESG considerations. We have that embedded in our investment process at Troy. We think these businesses stack up from an investment perspective, and also the fact that they are helping people move to a less harmful product. The board, of course, challenges everything we do. To answer the second part of the question, all investment decisions, strategy, how we're thinking about investing the portfolio. They've been happy with the approach that we're taking and understand how it is that we're seeking to balance quality, income and growth, and that the idiosyncratic opportunity that is presented by nicotine consumer products companies is a valuable addition to, we think, to a global income growth portfolio.
Okay, thank you. How important is it that companies have good brands?
Sorry, to repeat that again. How important is it?
Yes.
Yeah, really important, we think. People have been writing off, if you Google it, there's all sorts of papers called things like the death of brands that have been around for years, for decades. But actually brands perform a really important service. Now, it's fair to say that the barriers to entry for instance, consumer goods businesses are lower than they used to be. But the truth is the barriers to entry in almost every industry are much lower than they used to be because of the onward march of technology. But the reality is that people like brands and they perform a role. My colleague Tomasz Boniek always says that the biggest graveyard in the world is the second page of a Google search or an Amazon search, because people have got limited bandwidth, they've got limited time. And so they tend to just go for the thing that represents to them what they like, what they know, what's delivered a product or service to them which they value. And that really is what's encapsulated in a brand. And so it turns out, there was a lot of worries that as we moved online, as it became more digital, that brands would lose their cachet or would lose their importance. And it seems to be the opposite, because people have limited bandwidth and because the number of products that they consider in a digital environment is fewer, that brands are becoming more, not less valuable. So we would view the intangible value of brands as still very, very important and very valuable.
Have there been any sales? I mean, actually, no, that's a bit sort of strange. What I'm trying to say is maybe talk a bit about your sell discipline. What makes you sell a stock?
Yeah, so we sell company for three different reasons, really. The first is if the valuation becomes just simply far too high. That is quite rare. If you have very low turnover, if you have 10+ year holding periods, then you are willing to hold a business to slightly higher valuation than perhaps a higher turnover type process would countenance. We think that has a value. We want a settled high quality portfolio to be allowed to compound over a long period of time, and we allow therefore business to be trading at pretty full valuations on occasion, but not ridiculous valuations. The second is if we have a better idea, there is a continuous competition for capital in the portfolio as we seek to balance quality, income, and growth. And effectively, rather than have some notion of a benchmark, the existing portfolio is the existing benchmark. So if we can upgrade the quality, income, or income growth of the portfolio via opportunity, then we will do that. And that's the criteria in which we base it. And as I mentioned, there's a number of companies, world-class businesses that we know well, that we've been patiently waiting to buy that have come down quite a lot. So maybe we will be able to be upgrading the quality, income, and growth portfolio imminently, quite soon. And so if we have a better idea. The third one, of course, is we get it wrong. That does happen. Because we have such low turnover, because we have a high quality bar, and because we have a high degree of due diligence and new ideas, it doesn't happen very much, but it does happen. And if we get it wrong, then we must be willing to move on and learn from our mistake.
If you had a chart on this slide, the value versus quality slide, how would it look comparing your forecast dividend growth or portfolios to forecast dividend growth relative to that of the market?
I don't know off the top of my head, but I would say, for instance, in 2020, we were able to grow our income at a time when the market more broadly cut it significantly. So I would say that it gets back to this idea that if we can consistently generate decent value and decent growth in income, then we'll generate decent returns. So yeah, the answer is I don't actually know on a year-by-year basis how our growth compares to the broader market, but I think in absolute terms, a 2.7 to 3% dividend yield growing at sort of mid-single digits, if we can do that consistently, I think that's a really attractive return for investors.
Thank you. And then, is this something that you actually invested in yourself?
Yes, I do, yeah.
What about sort of Weinstock family? Are they invested in Troy's products?
They certainly are, yes. Weinstock family are invested across Troy's products. I am invested in the Securities Trust of Scotland, as are a number of other staff members. So we are all invested in our funds, as you would expect.
Great, that's a vote of confidence. That's good. There's a few questions about inflation. I suppose it's quite a hot topic at the moment.
Yeah.
Would anything change in the portfolio if you had stagflation or very high inflation?
So importantly, we're not managing the portfolio based upon an inflation forecast. We don't think that's sensible. And you're right, it's really indeterminate at the moment. Just to address the stagflation point, I've always thought that people love stagflation, I think just because they like the word. My personal view is that it can't persist for very long because it's sort of internally inconsistent. One will lead to either inflation will persist, in which case you'll have higher nominal growth, or growth will disappoint, in which case you'll bring inflation down. So I don't think those two things can coincide for very long periods of time. But what I do think is that we just don't know, and I think as I mentioned, although we don't know whether inflation is going to be more persistent or not, we do think that rates are likely to stay low, and that's because we think there's too much debt. And so you have this idea that if inflation dissipates, and after all, we've got inflation at the moment, or at least we've got a bump in prices. It's not quite the same thing as persistent inflation. I think we are still going through, I know we're going through the after effects of shutting the economy down as a result of what happened with COVID. And I think extrapolating anything or being too vociferous or too trying to put too much emphasis on forecasting anything very much at the moment is fraught with risk, because it's a very highly disrupted, difficult backdrop as we work through this. But against the fact that we've got recovering demand butting up against disrupted supply chains, and now the oil shock, we've also got much higher levels of debt, which puts downward pressure on inflation. We've got people are 1 year older, and demographics is a powerful deflationary force in our view. And we've got technological disruption. So the answer is, my hunch is, I don't know. And if you look at the aggressively flattening yield curve, that we might well be seeing peak inflation today. But it may also be that inflation remains more persistent. But I guess the short answer is no, we wouldn't be managing the portfolio differently based upon an inflation forecast. What we would be doing is trying to build a portfolio that's resilient and that is high quality. And the same attributes that allow businesses to earn high returns on capital employed, i.e. the same competitive advantages, persistent competitive advantages, are also those that allow businesses to raise price. And so we think that by putting a quality filter, if you like, by investing in quality businesses, you are also protecting your investors against inflation. It is also the case, and I'm sure your listeners have read the Warren Buffett 1973 essay, which is entitled How Inflation Swindles the Equity Investor. And he lays out all those years again a very cogent argument for why it is that capital light businesses are much better placed to withstand investment than capital heavy. And the reason is as they raise prices, they don't also have to raise capital expenditure. And so Warren Buffett, who's known for investing in the same sorts of businesses that we do, was actually investing in an inflationary time. And so we think these businesses are resilient to both a lower and in a high inflation backdrop. But the important thing is that we are not investing in the portfolio based on a forecast. We have lots of ideas should disruption in the market created by inflation or otherwise give us opportunities. But we think that the quality aspect means that we'll be robust to a range of outcomes, including a more inflationary time.
Brilliant. Okay, thank you very much for that. I think that's probably covered all the bases. There's still questions coming through, but actually, have you modelled your portfolio for a wartime scenario?
Yeah, I would just say Troy tends to people tend to be reminded why income is important in more challenging times, and people are reminded why Troy's investment approach is valuable in more troubling times. We are in more troubling times, and I'd like to think, therefore, that our approach and this trust and this mandate is pretty ideal for the backdrop that we face. I know I would say that, wouldn't I? But we do. So if we exclude the worst case, and I think we all know what that is,
yeah,
then I think we're pretty well placed for should we say a bit more of a challenging environment.
Great, thank you very much, James. I think that's quite a good roundup.
Thanks for the questions, and thanks for inviting me on.
Thank you. Right, so there we go. We'll be back next week. So we've got the fourth and final day of our Around the World webinars next week, and that'll be on UK. I think Jane will be talking to 4 managers, and there'll be a panel discussion. So do tune into that if you can. And then, and obviously, if you want to look at any of the ones that we've done already, so we've had the first 3 days. They're all up on the website. You can see the recordings, and also on our YouTube channel. And then next week, I'll be talking to Tom Williams from Downing Renewables Infrastructure, which is much more fully invested and ready to expand than it was the last time we talked to him. And then the next thing after that will be the Saturday at Master Investor in the Business Science Centre. So look forward to seeing you here, or maybe even in person soon, and hope you have a good week. Thank you very much for tuning in.